Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Sarah Hunt of Alpine Saxon Woods writing, investors seem positioned for positive earnings surprises into 26, but we expect higher volatility as summer gives way to fall. Sarah joins us now for more. Good morning, Sarah.
Good morning.
It's good to see you. What's the source of that volatility going to be?
I think the uncertainty that's coming around, the timing of what's happening in tariffs, the timing, like there was an announcement today that aluminum and steel in different products was going to be taxed at a different rate, and that it did include goods in transit. I think all those kinds of things make for problems for potential earnings. I think the uncertainty around what spending is going to happen, something like what's going on with Home Depot, not such a huge thing, not a big surprise, a lot of big ticket items, not so much people bought ahead of tariffs. But I think that there is some concern about what this is going to do to margins and what it's going to do to earnings. And that's going to, I think, add to volatility.
Well, let's stay on this. Which way do you think it breaks? Let's say we've got a company right now in America that was importing a lot of goods, a lot of pre-tariff inventory. Of the goods they imported that were tariffed, they were absorbing that on margin. Do you believe that's going to lead to, say, cost cutting, a labour market hit, or do you believe it leads to higher prices? They're going to pass it on to the consumer?
I think they're going to try to do both. I think they're going to try to get their costs in line as much as they can, and I think they're going to try to push price to the extent that they can. And the question really is, as these targets have been moving all year, did we get such a backup in demand that we pulled for a lot of activity, and are we therefore going to see some softness anyway? Or is this going to be so gradual that it doesn't have as big an impact as a big one-day slam dunk situation? And I think that's the question, and how this plays into PPI and CPI, because a tariff isn't really inflation itself. It's a tax, but it doesn't matter, because if the price levels are moving higher, it doesn't matter. To the consumer, it feels like a problem because prices are higher.
I remember a long time ago at the end of July when people said August tends to be volatile. Watch out, it tends to be the witching month. Well, we're up, 1.7% on the S&P. We've reached new high after new high. Sure, we've been down for a couple of days, but down is sort of a relative statement given that we're going nowhere. At what point are we just pushing off this volatility, showing that the pain trade still is higher?
So I think that right now, we've got Jackson Hole coming up this week. If you recall, last year it was the labor numbers in August that came in that really threw things off for the Fed, and people started to worry about the labor market. The data is uncertain enough that right now it's like it needs a push one way or the other. The fact that there is talks with Russia and Ukraine, whether they get to peace or not, that's probably a net benefit to most things except potentially energy, which is not the worst thing in the world either, because that helps everybody else with lower energy prices. I think the question's really going to be, where do we end up in terms of the consumer, and where do we end up in terms of inflation, and what happens to companies, and are they laying people off? Does that affect the labor market? All those interplays are uncertain now, and I don't know how much clarity we get in 3 or 4 weeks, but you could see some uneven data.
Right now, a number of people are talking about trying to just get a little bit more defensive. We see that in the investment grades market, with spreads getting to the lowest levels going back to 1998. And the theory here is there's going to be some weakness, and potentially you could see it in a stagflationary type of feel. Are we getting to a place where the high flyers, the tech-exposed stocks, will continue to perform even as the rest of the market continues to just kind of grind nowhere because of that type of dynamic of stagflation?
And because of the dynamic that there's still a lot of growth in that sector, there's still a lot of cash flow, and they're not being impacted as negatively as some of the companies that don't have the technology aspect. So as that technology flows through, maybe you do get some margin expansion from that, right? Because that's the big argument about AI, is that it's going to help us and it's going to help productivity, and that's going to help margins. So there's a little bit of an offset. Whether or not we get that, the big spend right now is still in technology. So those stocks are at a premium valuation for a reason, because people can see through and see forward.
Lisa mentioned investment-grade credit spreads. Let's spend a couple of minutes on that. This is important. Super tight. Tightest level since when? Was it 98?
98.
This side of this century, which is absolutely bonkers. Do you think that tells you more about confidence in corporate America, or a lack of confidence in the Treasury, in the US government, and in fact for sovereigns worldwide?
I think it probably has to do more with the confidence in the companies themselves and the balance sheets of the companies themselves. I think there's a little bit of that on the sovereign side because as debt levels rise globally, there is concern on the sovereign side that we hadn't seen prior to those massive increases in debt post the financial crisis. But if you look at the way that public companies, at least, have been managing their cash flows and balance sheets, there's a reason those spreads are so tight. One, it was a yield-chasing operation, and the other one is they're in pretty good financial shape. There isn't a lot of credit weakness on a lot of the publicly traded stuff. So the IG and those spreads are very, very narrow because there isn't a lot of daylight between that right now.
There's another way of asking what John asked, which is, even with spreads at the narrowest since 1998, is there still value because there is any spread above benchmark government rates, given that their creditworthiness on some level might be better in some respects than the U.S. government?
I think that's one of the reasons that you saw some of those corporates be able to borrow at ridiculously low rates, right? Because people looked at them and said those stabilities of cash flow are way better than some governments that I've seen. I think in the end, there's always a place for fixed income when it has finally a yield, which it does. If you're matching portfolios, if you're matching exposure, or if you're just looking for safety and preservation of capital, there's always a space for that. And I think that right now, it's not a bad place to be if you know that you need that money in a short period of time. Longer term, do we think that rates maybe go higher in the long end? They could. It's unusual to stay this low for this long.
Are corporate bonds a better hedge right now, a better safety play than government bonds, given the fact that they also have these strong balance sheets behind them?
I think that the volatility in governments is much more policy driven than it would be for corporates. So to the extent that you might see more volatility in the government market, and we have over the last year, which is the last couple of years, it's more surprising to see that much volatility in government spreads. So to the extent that there's less vol in the IG market, I think that's not a wrong thought.
Sarah, good to see you. Thanks for dropping by. Thoughtful stuff. Sarah Hunt there of Alpine Saxon Woods. Joining us now to build on the conversation, retired Lieutenant General Robert Walsh of Academy Securities. Lieutenant General, welcome back to the program, sir. We've been tracking the diplomatic effort in the United States, in Alaska, then down in Washington. Could you tell us what the realities are of this conflict on the ground?
Yeah, thank you, John. This war has been going on, obviously, for a long time. And when we talk about a stalemate, Russia's been making slow progress on the ground. There's no question about that. It's a much larger country. It has a lot more military power, but it's been very slow progress. And the real challenge for Russia is in today's modern warfare, the defense is more to an advantage than the offense. And Russia is running into that against the Ukraine belts of defense. And what we see clearly here is they're getting closer to the Ukrainian main defensive belts, or their fortified belts. That's the area of the Donetsk region that Russia really would like to get their hands on for a number of reasons. It's part of the industrialized area of Donetsk. It's got a lot of key minerals that are in that area. But from a military standpoint, and that's where Putin is really focused, from a military standpoint, it has the key defensive areas around 4 major cities. And urban conflict, as military members know, is the toughest warfare to go through. And that's where Russia or Ukraine has their forces entrenched in this defensive belt.
Lieutenant General, how much of a win, then, is it for Vladimir Putin to not have a ceasefire as some of the details of this potential trilateral meeting take place?
Yeah, that's a great question, Lisa. I think both the U.S. and the Europeans did want a ceasefire. And the situation is the Europeans and Ukraine, certainly in the U.S., would like to end the war more than Vladimir Putin would like to end the war. So a ceasefire helps end the war, stop the fighting right now, and stop the killing, as Donald Trump has put out. In the case of Putin, he would like to just continue. So these talks, he continues to kind of slowly drag out because he wants these battlefield gains. The more gains he gets on the battlefield, the more leverage he has, and the possibility of a breakthrough that could happen. And he could even gain more gains and threaten more of the heart or the interior of Ukraine.
As we hear more about security guarantees and some sort of agreement between the U.S. and Europe to guarantee some sort of support to Ukraine, do you feel more encouraged or less encouraged? Do you still kind of feel like the jury's out?
No, I think very encouraged after what's happened over the last few weeks. There's no question that the meeting yesterday at the White House was historic. I don't think we've ever seen that many national leaders, along with the leader from the EU and the NATO secretary. We haven't seen anything like that at the White House. What that really shows is the power, the unity, the strength that NATO is bringing, and the ability to kind of coalesce power for collective security. And that's a key thing here, that Vladimir Putin throughout this conflict has tried to break the NATO alliance, tried to break the U.S. from NATO. And if anything, what this showed around that table yesterday is those leaders, as Ali had said, have really kind of come around the table to show Putin that there is a lot of strength here. And it's not only military strength that's here. We know Russia has continued their wartime economy to build their military, but the economic strength that you see from the group that was around the table, it is much larger than Russia is, and Putin knows that.
Lieutenant General, just a final question. You mentioned NATO. The details of this security agreement, in your opinion, why does it need to live outside of NATO? Why is that so important? And what does that tell you about really the nature and strength of that overall agreement in the future?
Yeah, John, it's a great question. I think the key thing is if you look at Putin's objective from the very beginning, is to rebuild the former Soviet Union and break NATO. That's his goal. That's his objective. And a red line for him from the very, very beginning was Ukraine not joining NATO. And from the beginning, President Trump, as he came into office, laid that down, that he knew that would be a red line, and took that off the table, and the Europeans supported that. And so now when you get to some type of security measures, it is so important to have security measures that when the fighting stops, that there are security guarantees, and that is going to be the devil in the details as we go forward. And Putin will not want to have an Article 5 type security arrangement. And what that means is that we would be supporting Ukraine through the European countries, those that are in NATO, with the same type of support that they would get as if Ukraine was in NATO. It was a very interesting approach that Trump took and pulled that out of his hat. And Vladimir Putin listened to that and initially said he would take a hard look at that. So I think that is going to be the key thing. And Zelensky is going to push very, very hard to get those type of assurances from the large militaries.
It's the breakthrough we all wanted to see, sir. Lieutenant General, we appreciate your time. Kit Juckes of SocGen writing, the more prices rise in the data, the worse it will be for the economy. And the Fed should focus more on the labour market as a result. If they do that, the dollar will be vulnerable. Kit joins us now for more. Kit, welcome to the programme, sir. Let's talk about this FX market, driven in the first half of this year by perceived capital flows. Do you believe that in the second half of this year, it will be driven by rate differentials, and why?
Rate differentials up to a point, expectations about growth, which are often the same thing. But yes, I think people are genuinely uncertain in the sense of, at the moment, they're uncertain but aware of the fact that the world is very long dollars because we've all put so much money into the US equity market, because money's gone into the US Treasury market, because the US has been outperforming for so long, and that if the economy slows, rates need to come down significantly, then some of the returns people have enjoyed are pretty vulnerable. I think the market's confused about the short-term rate story, but confident that the answer is the US economy slowing a little, or is it in more danger of a more significant slowdown? And that means we're overreacting to every single piece of macroeconomic data, with the exception perhaps of the really sort of minor data we saw yesterday. But we're lining up to overreact to each piece we get going into September.
Taking a step back, Kit, earlier this year, it seemed like a one-way freight train of sell dollar, sell the United States. That was the trade, and pretty much everyone lined up behind it. Is it over? We've kind of plateaued and kind of shifted around this level for a couple of months now. Are we seeing sort of the end of the sell the America trade and going back to this sort of nuanced, overreacting to every data point type of landscape?
I think the data will decide that. I think the question then is whether the US economy is slowing significantly. I mean, a currency can't go down as fast as the dollar did or go up as fast as currencies like the euro did for very long. An inflation targeting central bank reacts to fast currency moves. An economy reacts to fast currency moves. So the move we had in euro-dollar from 102 up to 118 was too fast. We have to take time out. Whether that takes us to 125 or we get stuck here depends on how much or how little the US economy slows in the next 3 months, I would have said. And if we got a repeat of last month's payroll numbers, if we got something genuinely soft, then I think we're going to head off into the middle of the 120s for euro-dollar. We've got another 5 to 10% weakness in the dollar in this cycle to come. But you know, I wouldn't want to overinterpret some of the data that we've had in the summer and extrapolate it out blindly as saying that is what's definitely going to happen. Again, if the inflation hit from tariffs isn't too big, the economy's not going to slow too much, and a very gentle easing in US growth doesn't justify much dollar weakness at all.
So let's build on that. Right now we're looking at 116.88 on the euro-dollar cross. You're saying it could go into the mid-120s if you do see some sort of significant weakening in the US economy. Heading into the fall, what are the key data points that you're looking at, and what would constitute that type of weakness that would really cause that type of depreciation in the dollar?
So we would set ourselves on that route if we saw weakness that suggested not recession or anything, but that the Fed's got significant rate cuts to make, that we're going to get yields down, that the things that have made people pour their money into US assets need to be questioned at least temporarily. So if we saw a payroll number in the United States that was, I don't know, say only up 100,000 or weaker than that at the beginning of September, I think that would concern people. If you saw weakness in the housing market beyond a small correction, if you saw softness in real personal spending as consumers scale back in the face of higher prices, then I think you'd be sort of forming that kind of backdrop. The advantage for the consumer who's critical in this is if the inflation data continues to be held back by lower energy prices. So if low energy prices offset tariff increases, or if tariff increases aren't fed through to US consumers, it all softens the economic blow, and the downside to the dollar is reduced.
Kit, we're all still wrestling with this, and I imagine many on the committee of the Federal Reserve are wrestling with the very same thing, which begs the question going into Jackson Hole, just how much can we expect? Neil Dutta, Renmac, don't expect a strong signal at Jackson Hole. Jonathan Pingler, UBS, if you're looking for rate cuts, he says, quote, I don't think he's going to lock it in. Kit, do you think he's going to lock it in a few days' time?
I'd be surprised if he locks it in, but the topic of the symposium is the labour market. The labour market is going to be the thing that tells us what's happening to the economy. So we should hear a really interesting set of discussions about how they feel about the labour market and how they feel about labour market tightness relative to softness in employment gains. And if I get any hints from that, I will jump on them to provide me with a clue to what they'll do. But I think that, again, if the jobs numbers are weak at the beginning of September after what we saw last month, frankly, the game's up. So that'll tell us what happens. But it'll be a very interesting symposium on the labour market. Okay,
just before you go, what's more likely over the next 12 months or so, that we get 3, 4, 5 rate cuts from the Federal Reserve, or Arsenal win the league?
3, 4, 5. I think Arsenal have got a decent chance of winning the league. I'm slightly more optimistic about that than about anything in the US economy, which is all up for grabs.
Okay, thank you, sir. Kit Juckes there of SocGen. Okay, thank you very much. On the FX market and a little bit of Premier League football. Priya Misra of JPMorgan writing, the dual mandate is in tension, but we think a September 25 basis point rate cut is likely and a signal for more cuts to come as the Fed removes the level of restriction in monetary policy. For more, Priya joins us around a table. Priya, good morning.
Morning.
It's good to see you. RBC has talked about this. A lot of people are focused on it. Is the long end becoming unanchored from the front end? Not just domestically, but worldwide when you look at the bond market at the moment?
So I'm glad you bring up the global side, because I think that's absolutely important. Global term premiums are correlated. The fact that we have fiscal expansion globally, the fact that there isn't that much demand for long duration is the reason why UK, German, Japanese long end yields are rising, and that's raising US rates as well. But I mean, talking about the long end getting unanchored, sell America or the deficit, that's like very April. I mean, I know it was only a few months ago, but you look at the tariff revenues, they're coming in, they're actually offsetting the OBBB, the One Big Beautiful Bill. I think it's going to largely offset it. You look at the sell America trade, we're not seeing evidence that foreign investors have stayed away. Now, there is a longer term question. How much should Treasury, and I love your question to Secretary Besson, how much should you issue in the long end? I think all Treasury departments have to think about that and maybe not issue as much in the long end. And that might be happening. Issue where the demand is. The demand, and you see it in the credit market, the mortgage market, the Treasury market, demands in the belly of the curve, 5 to 10 years. That's where they can issue. So yes, it's a little unanchored. You can trade the curve on that front. But I don't think we're looking at a scenario that bears steepener, which is the nightmare scenario for risk assets as well, is when all rates rise led by the long end. We're not seeing that. I think the curve is steepening for different reasons now.
Are we going to see the opposite? You said that sell America is so April. Okay. Are we actually outright into buy America again as we see the dollar firm up in a couple of different pockets? And the long end, yes, yields have been rising, but not necessarily unmoored in the way a lot of people were worried about.
Exactly. So I do think that U.S. exceptionalism, remember we talked about it just a few months ago, is that over? Look at the economic data. We're pricing it. Look at financial markets. You know, I know the financial markets is not the economy, but it is pricing in. I think markets across the board are pricing in a soft landing and what Governor Waller called good news rate cuts, that maybe the Fed can reduce accommodation, those rates can fall a little bit, allowing the broadening out of the recovery. I mean, we have the structural AI tech capex in there, but maybe this can broaden out. That's what the market's pricing in. So to your question, is the rest of the world buying U.S. assets? They are. They're buying credit, they're buying equities, they're buying treasuries, fixed income, because they are seeing that the U.S. is still growing the best.
Are you going long duration? Is this a time to buy, even at a time where potentially there is inflationary pressure coming down the pike?
So we are long duration. We've looked for any opportunity. We've been in this 375, 4.5 fair value in our mind. That's the soft landing fair value. There's an asymmetry though. If things slow down, we have a lot of policy shocks that have hit the economy. If things slow down, we can absolutely rally more. But if we stay in this soft landing, by rally more I mean lower rates, but if we stay in the soft landing, 430 on 10s is cheap. You're near the upper end of the range. So absolutely, we've been buying some duration. Are we max long? No. There's, to your point, the Treasury interest rates are driven by this fear of inflation, fear of growth. There are shades of stagflation in the data right now. I don't think Chair Powell is going to commit to a rate cut. I think he's going to just signal the easing bias. So we might hang around here. But what happens if I think the labor market's on edge. And if things actually slow down, as companies say, we can't absorb all of this in margins. We're going to have to cut costs. That's a fear. That's what keeps me up at night. And at that point, duration's the only friend.
Do you think there's scope for disappointment on Friday?
I think we get a lot on Friday. So I always think of the economic outlook and the reaction function. If you're looking for Chair Powell to signal imminent rate cuts or a dovish reaction function, I don't think we're going to get that. I think it's going to depend on, so where the disappointment might come in is, well, he didn't commit to September. He still left the door open because we have another payroll report, revisions. Now, I think the market might pay more attention to revisions along with that number, something that frustrated me for years, that you get both sets of data and the market always looks at the headline. Maybe we'll look at both. You have another CPI report. So I think where the disappointment will come in is no commitment, but I'm going to be watching that framework review. That's going to sound maybe a little bit hawkish. They're going to talk about symmetry to the unemployment rate, symmetry to inflation. Yeah. That might sound a little hawkish, but I'm watching the economic outlook. How nervous is he that consumer spending has slowed, that PDFP, the private domestic final sales, that number is slowing without that much rise in inflation. So why is the consumer pulling back if companies are not passing on costs? It means there's maybe some underlying slowing here.
Priya Misra of JPMorgan.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.